Welcome to Iron Financial. We're the place you come to forge a stronger portfolio because we stress test the market's biggest stories. And today, we are putting Symbotic, that's ticker SYM, right under the microscope. Look, their latest earnings report just hit the street, and frankly, it is a complete mess of contradictions. You've got headlines that look absolutely terrible, the market is running for the hills, but if you listen to the management team, you'd think they just won the Super Bowl. Our job here is to cut through all that noise. We're going to analyze the very structure of this company and figure out, once and for all, if this thing is built on a solid steel frame or if it's just a house of cards that's about to get blown over. All right, let's get into it.
So let's start with the foundation, because on the surface, man, it looks seriously cracked. The number that sent every trading algorithm into a selling frenzy was the earnings per share, or EPS. The street expected 8 cents. Symbotic delivered just 2. Now that's not a miss, that is a crater. A 75% shortfall from expectations. And you know what happens next? The market doesn't wait around for excuses, it just hammers the stock, down almost 5% on the news. When you miss by that kind of margin, investors hit the sell button first and maybe ask questions later. This is the single data point that puts the entire bull case on its back foot from the word go. Whoa, hold on a second. So the company misses earnings by a country mile, the stock gets taken to the woodshed, but the CEO, Rick Cohen, he gets on the conference call and says with a straight face, "We're off to a strong start this fiscal year." How on earth do you square that circle? This is the kind of thing that drives me crazy. It makes you question everything. Is management just trying to put a brave face on a terrible quarter? Are they spinning? Or is there something real, something powerful happening under the hood that the market is completely missing? It feels like they're telling us the building is a fortress while we're all standing here watching a massive crack run right up the main wall. So that's the real fight we're breaking down today. What is the actual story here? You've got two completely different narratives. Is the market right? Is that headline miss a sign of deep fundamental problems with the company? Or is the CEO right and the underlying business is so powerful that this miss is just, a bit of spilled paint on a much bigger, much stronger construction project? Well, we are going to find out. We're going to pull out the blueprints, we're going to check the load-bearing walls, and we're going to figure out if this is a solid structure you can invest in or a fragile house of cards ready to collapse. All right, to get to the bottom of that, we have to do our job. We have to tune out the panic, ignore the screaming headlines for a minute, and look at the actual steel frame. We are going to do the heavy lifting and analyze the hard numbers that make up the bull case for this company. We are going to lay out the core metrics, brick by brick, that point to the real operational strength here. This is where you find out what's really going on. First things first, the top line, revenue, the big number. For the quarter, they brought in $630 million. That's a 29% jump from this time last year. Now, that's not just solid growth, that's really strong growth. But here's the kicker. It also beat Wall Street's expectations. Analysts were looking for $622 million. So think about that. While the market was losing its mind over the earnings miss, Symbotic was actually selling more of its stuff than anybody thought they would. This tells you right away this company doesn't have a demand problem. They are executing on sales, they are growing fast, and that is the absolute first pillar of any solid investment case. But here's where it gets really interesting. It's not just that they're growing, it's how they're growing. You gotta look under the hood. Their core business, systems revenue, the actual hardware, that's up a very healthy 27%. Great. But look at these other two bars. Operations services, up 68%. And then there's the crown jewel, the real story. Software revenue, up an absolutely explosive 97%, almost doubled in a year. This is so critical because software is the holy grail, right? It's the high-margin, super sticky, recurring revenue that investors fall in love with. To see that business line nearly double tells you that their whole ecosystem is getting stronger. They're not just selling robots, they're selling an entire platform, and the most profitable part of that platform is on fire. And all of that incredible growth leads us right here to the next major milestone in the company's structure. For the first time ever, Symbotic is GAAP profitable. Now, for those of you who don't know, GAAP is just the official accounting rulebook. It's the standard. So this isn't some fuzzy, adjusted, made-up number. This is real profit by the book. They posted a net income of $13 million. Now, to really understand how huge that is, you have to look at last year. This same quarter last year, they had a net loss of $17 million. That is a $30 million positive swing in just 12 months. For any high-growth company, hitting GAAP profitability is like a rite of passage. It's the moment you go from just burning cash to grow to building a sustainable business that can actually fund itself. This isn't just another number, folks. It's a fundamental change in the company's DNA. And if you thought that was good, it gets even better when you look at the metric that management really focuses on, adjusted EBITDA. Think of it as a raw look at the core operational health of the business, without all the accounting noise. They posted $67 million there, which smashed their own forecast. But even more important is this. It was the first time they ever hit a double-digit EBITDA margin. Hitting double-digit margins is a huge deal. It shows serious operating leverage. It means as they make more money on the top line, an even bigger percentage of that money is falling to the bottom line as profit. They're getting more efficient. So the bull case is pretty clear, right? Revenue is beating expectations, high-margin software is exploding, and they just crossed that crucial line into real sustainable profitability. From this angle, the steel frame looks rock solid.
All right, I hear you. The steel frame looks impressive, I'll give you that. The high-level numbers you laid out are definitely shiny. But as we all know, a beautiful skyscraper with a great frame can still come crashing down if the foundation is flawed. A shiny frame doesn't mean a thing if the concrete in the foundation is mixed with sand. So now it's time we stop admiring the view from the penthouse and get out our inspection tools. It's time to go looking for those hairline fractures, the hidden weaknesses, the things management is hoping you'll overlook while they point to that shiny revenue growth. Let's find the cracks. And we have to start with the big one, the crack that shook the whole building, that 75% EPS miss. You can't just brush that off. Wall Street analysts, the people whose entire job is to model this stuff, they set their expectation at 8 cents a share, and the company came in at just 2. Now, being profitable is great, but when that profit is only a quarter of what everyone was expecting, it raises some really serious questions. What went wrong? Did their costs spiral out of control? Did their margins get crushed unexpectedly? A miss of this size, it suggests a real lack of control, a lack of visibility inside their own financial house. It tells me that for all their talk about discipline, they can't even accurately predict their own bottom line from one quarter to the next. That's not just a hairline crack. That is a sinkhole opening up right under the foundation. And believe me, that sinkhole gets a whole lot deeper when you look at this company's recent history, because this isn't the first time their numbers have been, well, questionable. We have to talk about the elephant in the room, the major financial restatement they had to do for fiscal year 2024. They had to go back and publicly change their own numbers, cutting revenue and profit by $30 to $40 million. A restatement, for anyone who doesn't know, is one of the biggest red flags in the investing world. It's a company basically putting out a press release that says, hey, you know those numbers we swore were true last year? Yeah, they weren't. In a market that runs on trust, a restatement absolutely destroys credibility. So this is the crucial question you have to ask yourself. If this company has already admitted publicly that they got their numbers fundamentally wrong in the past, how can you, as an investor, have 100% faith in the numbers they're giving you today? That shiny new first-ever GAAP profitability we were just celebrating? Well, it suddenly looks a lot less shiny when you remember it exists in the shadow of a massive accounting screw-up. It forces you to wonder if this new profitability is real and sustainable, or if it's just another number that might get restated down the road. This track record is a serious structural flaw that you just can't ignore. Now, this next point, I'll admit, might be a smaller crack, but sometimes small cracks are how the bigger problems start. You have to follow the money. We look at the Form 4 filings. That's the public record of when insiders buy or sell stock. And we see that on February 2nd, just a handful of days before this ugly earnings report came out, a director on their board, Todd Krasnow, sold 4,000 shares. Now, is 4,000 shares a huge amount? No, and it was part of a pre-scheduled trading plan. But the timing, wow, let's just say it's interesting. Insiders have the best seat in the house. They know what's really going on. So while we're not saying it's illegal, seeing a director cashing out some chips right before a report that sends the stock tumbling, well, it doesn't look great, does it? It's just one more reason to wonder if the insiders are really as confident as the CEO wants you to believe. Okay, let's put these cracks into perspective. A 4,000 share sale from one director, that's a rounding error. It's statistical noise, not a structural threat. And the restatement, it's a black eye, for sure. They had to own it, but it's in the rearview mirror now. If you spend all your time focusing on these small, backward-looking issues, you're complaining about the paint job while a 100-story skyscraper is being built right in front of you. Investors who get bogged down in these details are going to completely miss the big picture. So it's time to look up. It's time to examine the long-term blueprint for this company, because this is where the real value is being forged. And this is the skyscraper. $22.3 billion. Let that number sink in for a second. That is their contracted order backlog.
This is, without a doubt, the single most important number in this entire story. This isn't a sales forecast. This isn't a maybe. This isn't hope. This is a mountain of legally binding, signed, sealed, and delivered contracts from some of the biggest companies in the world. What this number gives them is an almost unheard of level of revenue visibility for years, maybe even a decade to come. Most companies are out there fighting and clawing for their next sale. Symbotic's biggest problem is just building fast enough to keep up with the demand they've already locked in. This backlog, this is the bedrock foundation that makes a short-term EPS miss look like a tiny tremor, not an earthquake. Okay, so you've got the blueprint for this massive skyscraper, that giant backlog, but you still need the cash to buy the steel and hire the workers to build it. Do they have it? Oh yeah. Symbotic is sitting on a war chest of $1.8 billion in cash, and they just beefed that up by raising another $424 million from a stock offering. The fact that they could raise that much cash that easily tells you that the serious players on Wall Street are more than willing to fund their growth. This isn't a company scraping by. This is a fortress balance sheet. And $1.8 billion in cash isn't just a safety net. It's a weapon. It lets them outspend, out-innovate, and outlast any competition. And they are not just sitting on that cash and that backlog. They have a clear three-front attack plan for growth. Step 1, go deeper with the whale. They're working with their biggest customer, Walmart, to dominate the future with next-gen fulfillment prototypes. Step 2, expand the battlefield. They're moving beyond grocery into totally new areas like clothing and auto parts. That massively increases the size of the market they can go after. And step 3, buy your way to dominance. They're making smart acquisitions like the recent purchase of Fox Robotics, a leader in autonomous forklifts, which just plugs perfectly into their existing system. This is a company playing chess, not checkers. They have a clear blueprint for total market domination. And if you really want to understand their secret weapon, their competitive advantage, just listen to what the CEO himself says. We sell the software, we integrate the software, we make the machine. Think about how incredibly powerful that is. They own the entire stack. They aren't just selling you a car, they're selling you the car, the engine, the proprietary fuel, and the only mechanic service authorized to work on it for life. They control the hardware, the AI software that runs the whole show, and the services that keep it all going. Once a customer like Walmart builds their entire supply chain around this ecosystem, they are not leaving. That is a fortress of a business model. And finally, let's talk about the future. Is management scared by that EPS miss? Are they hiding? Not a chance. They are putting their money where their mouth is. Just look at their guidance for next quarter. After doing $630 million in revenue this quarter, they're guiding for $650 to $670 million in Q2. That's confident, continued growth. They also expect their operating profit to climb even higher. This is not the guidance of a management team that's worried. This is them looking the market right in the eye and saying, you're wrong to be selling. That earnings miss was a speed bump. The engine is roaring and we're about to hit the accelerator. Okay, so we've laid out the bull case, that beautiful steel frame reaching for the sky. And we've brought out the inspection tools and found the potential cracks in the foundation. We have seen the good and we have seen the bad. So, where do we land? It's time to weigh all the evidence and deliver the final verdict from Iron Financial. Let's put it all on the table side by side. The steel frame, the bull case, is formidable. You've got 29% revenue growth, that huge milestone of first-ever GAAP profitability, soaring software revenue, a rock-solid cash position, confident guidance, and all of it is built on that incredible $22.3 billion backlog. That is a powerful, powerful case. But you can't just plaster over those cracks. That massive 75% EPS miss is a serious execution problem. The market punished the stock for a reason, and that history of a major financial restatement casts a long, ugly shadow over the numbers. You add in the insider selling and general market risks, and you absolutely have a legitimate case for being very, very cautious here. So here is our final verdict. At Iron Financial, we see Symbotic as a fundamentally sound build that is currently suffering from some very serious headline risk. Yeah, I agree with that. The cracks we pointed out, they are not cosmetic. The EPS miss, the restatement history, these are real risks. They speak to execution and to trust. And they are exactly why the stock is so volatile and why some investors probably should stay away. But, and this is the critical but here, the underlying structure, the core engine of this company is just too powerful to ignore. The revenue growth, the profitability, and most importantly, that colossal backlog, it forms a foundation that we believe is strong enough to withstand these short-term shocks. The market is trading the ugly headline, but the long-term story is being written by that backlog. So what does all this mean for your portfolio? Here are the key takeaways. First, you've got a classic disconnect. The market is punishing a short-term miss, which could be creating a gap between the current stock price and the long-term value locked in that backlog. Second, your homework from here is to watch for sustained GAAP profitability. Was this quarter a one-time thing, or is it the start of a real trend? The next couple of reports will tell that story. And always remember that the $22.3 billion backlog is your North Star. As long as that's solid, the long-term bull case is intact. But that history of restatements means you have to watch their financial reports like a hawk. You have to be more skeptical here than you would with other companies. It absolutely warrants caution. And finally, and this is the most important part, know what you're buying. This is not your grandma's stable utility stock. This is a high-growth, high-volatility bet on the future of automation. You have to have the stomach to ride out these wild, headline-driven swings if you want to be there for the potential long-term growth.
So we'll leave you with this one final question to think about. When a company has a $22 billion blueprint for its future, a clear runway for years of growth, is one bad 75% earnings miss just a bump in the road, a temporary setback during a massive construction project, or is it a fundamental warning sign, a signal of deeper structural flaws in their ability to actually build the thing they've promised? That is the multi-billion-dollar question you now have to answer for your own portfolio. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.